Good morning, everyone, and happy Wednesday. It is time for Weekly Profit Talk. We do this live every Wednesday at 8:30 a.m. Mountain Time. If you happen to be in California, that's 7:30, and for you East Coasters, that's 10:30. And the Heartland, Chicago, and all you guys, of course, that's going to be 9:30. So uh, chances are you may be watching this in replay. Welcome either way. If you would like to catch us live, we do this every single Wednesday. Now, having said that, we are going to skip next Wednesday, which is Christmas morning. I want to spend time with the family. So we'll provide some special form of content for you for that week. And it's something I'm going to do pre-recorded. But beginning with the very first day of the new year, which happens to fall on a Wednesday, we will be back live and bringing you as much value as we can to help you in your medical practice save more on taxes and uh, keep more of your cash and your profits. Um, so I guess this is the last live of the year, and I decided to land on a fairly simple but important topic, which is the medical practice tax game. A Painless Guide is the title of what we're doing today. And so we're basically going to go over some fundamental information, things that you may, if you've been in practice for a little while, already know, but it doesn't hurt to repeat it or to hear it again. And if you have any questions about anything, by the way, remember that we are coming to you live or on replay in 3 different media. You could be watching this on YouTube, LinkedIn, or of course Facebook. And every single one of those has a comments section. So if you have questions, want to talk, or even want to talk more about how I might be able to make you and your practice wealthier, and especially saving you money on taxes, then shoot us a note. And let's begin. So first of all, let me go ahead and I'll do this. They changed my functionality here. Okay, that is not what I want. Hang on a second here. Sorry, I appreciate your patience. There we go. So, first of all, you went to medical school and then went through residency. Your education process took you, I'm certain, somewhere between 9 and 12 years. I'm guessing 11 generally. And that's quite a long time. So, in all that time, you basically have I've done all the mnemonics to learn all the different parts of the body and the chemistry and the things. But chances are you got precious little information on how to actually run a business. But you have ventured forth into running a medical private practice. Um, large groups are large medical groups are kind of becoming more the norm, and they're easing private practices out. So if you're in the game, you are basically an entrepreneur. First of all, congratulations. The world needs more people like you. So I want to help as much as I can. Out of the gate, you're basically self-employed as opposed to being employed for somebody else. So simply, you can report all of your income and expenses on something called Schedule C, attach that to your 1040, and you're done with your tax filing obligation for the year. It sounds simple. You don't have to complete your filing until the normal April 15th deadline, assuming that your calendar year. And yes, you want to be calendar year. Many reasons why. If you're not sure, ask. But you do want to be calendar year, especially if you're married. You'll be dragging your spouse through an otherwise fiscal year. So I digress. I'm sorry. So you can file as a self-employed individual, but the problem with that is that self-employment and filing a Schedule C creates a necessity for your Form 1040 called a Schedule SE that stands for self-employment. And that is the way that the federal government collects Social Security and Medicare tax from you. If you file Form SE, you're basically paying all of the 15.3%, both sides of Social Security, the employer and the employee side, minus a small adjustment on the first page of the 1040. The effective tax rate is 14.13%. That is tax over and above ordinary income tax. If you make $100,000 in a year, that is $14,130. And that is before you pay a penny of income tax. Married, single, you're probably paying over a quarter of everything you make in taxes if you're self-employed. So once you get beyond a certain point in your income, 100,000 is ideal. I've got 80,000 written down here because this is a point at which I'm able to save money as an S corporation for my medical practices. So what that is you become a corporation for tax purposes, but your income flows through to your 1040 on another form. You do file a second tax return, and that has to be done a month earlier. This year, in fact, that's going to fall on Monday, March 17th. Uh, Deadlines never fall on a weekend because it's not a banking day. So um, you'll file an S corporation return, which will in turn create something called a K1, and that will report your net income to your 1040. Now, the reason you want to do that, no more Schedule SE. That goes away. You do still need to take a wage from your business, but it can be a reasonable compensation, which is the term the IRS uses. I like to say that if you are making a good faith effort to take a reasonable compensation from your business, they don't expect you to pay yourself a doctor's mean salary of whatever it is, $120,000 if you only make 100. So let's say that $100,000, okay, um, and you take 48,000 of it as wage. The remaining $52,000 completely escapes the self-employment tax, and you save, and I know this math, $7,700. So that's important to keep in mind that, in fact, in your very first year, if your projected income after all overheads is going to be in six figures, you definitely need to consider electing an S corporation as soon as possible. We are also it's a specialty of our practice, and we're certainly able to help if you have any questions about that. So another thing is that you, as an entrepreneur, no longer have a nanny, i.e., an employer, taking your taxes out of your paychecks for you. You've got to do withholding yourself. Now, the good news is that withholding only occurs 4 times a year, not every single month or every time you take money in, but you are reporting what's known as an estimated tax payment. Uh, these occur in the middle of April, June, September, and January. And yes, I know those are the 4th, 6th, 9th, and 13th months. So they're offset a little bit. The middle two has something to do with the federal fiscal year. So main thing is if you are paying as close to your tax obligation for the period of time that has previously elapsed, let's say the June payment, for example, you want to estimate your taxes based on your income from January through May, and then you multiply that by 2.4. Okay. And that will 5 months into 12 months is what that'll do for you. And then you have your income, figure the tax on that, divide that by 5/12, multiply by 5/12, excuse me, and you've basically got estimated tax. Send that amount in. I round it off to a whole hundreds amount. And if you do this as you go, the IRS actually does note here that I said they're annoying pay-as-you-go requirement. They do believe that they are a pay-as-you-go. If you do not pay until you file in March or April, you're going to pay underpayment penalties for not having paid during the year. That's one thing. But the other thing is you have the soul-sucking feeling of knowing that you're going to have to come up with all the tax money all at once. So there are two really good reasons to do this. And the other one is the peace of mind of knowing that you're taking care of this as it goes. In fact, let me see. I didn't say so here, but there is actually an accounting principle. It's called matching, and it basically states that you, to the best of your ability, need to match your expenses to the period in which you receive the revenue. And estimated tax payments actually meet that nicely. So again, if you're making a good payment in April, that's going to be the period January through March. Then when you get around to doing the one in June, you'll do January through May estimation, figure the whole thing out, figure out your tax, subtract the amount that you paid in April. Yes, I know that's inconvenient because that's also the tax deadline. But if you do this the way I'm telling you, what's going to happen is when you go to file your taxes, you're actually going to love a tax filing season. because you're basically just filing a reconciliation. You've already made all your payments because you've made, to the best of your ability, a payment to within $1,000 of your actual tax liability by the middle of January. And when you file, you shouldn't owe any more than $500 to $1,000, or perhaps even have a small refund. Now, large refunds, I'm dead set against because the IRS is holding your money and stealing your uh, savings rate from you. But that's a subject for another time. So, love tax filing season? Really? Absolutely. Um, and I've already mentioned this. You do want to owe less than $1,000. That's actually the IRS's parameter. Now, I know that you'll read something about 90% of the previous year and 100%. The best thing that you can do, and going back to that matching thing I was talking about, is to match the expense of your taxes as closely as possible to the period in which you made the money that created the tax in the first place. Never mind the 90% part. Sure, you can pay in a little bit less, but what exactly is the point of that? You should, in fact, actually make a good effort to the best of your ability to pay as close to the obligation each of those 4 periods as possible. You're going to owe over $1,000 in tax if you make $100,000. I promise it's going to happen. So estimated tax payments need to become a part of your very essence. It's a very important part of your personal tax planning. And if you, in fact, have done this, then the money's already been paid in. You've got that clean room in the back of your mind, and you have a much smaller obligation without any underpayment penalties. And you can actually look at your tax return for what it truly should be, a report of your taxable income for the year. And that's basically it. So um, once you move from a point where you're making very little money to where you believe that you'll be exceeding $80,000 in net income, the S corporation election is this should be your next step. If you have any questions about any of that at all, we are here to help. So, again, we're on Facebook, YouTube, LinkedIn. All three of them have a comments capability. You can write me that way or just write to Eric at owingsllc.com, or our websites at owingsllc.com. And you can actually book time to talk to me about how we might possibly work together and make you wealthier. Uh, the whole point is more cash, more profit, and less tax. So, with that, I'd like to wish each and every one of you a very Merry Christmas and a Happy New Year. Um, we will be back live on the 1st of January. And again, if there's anything that we can do for you at all, please reach out. Have an amazing holiday season. And if you do have a chance, do something randomly kind for a stranger today. With that, so long. And again, happy holidays. Bye for now.